Welcome back to The Explainer. I am so thrilled you're joining me today. We are going to put on our professional equity analyst hats and conduct a really rigorous, no stone unturned stock valuation. Our target for today? Macerich, trading under the ticker symbol MAC. Now, they are a massive real estate investment trust, or REIT, focused on top-tier regional malls. But listen, we aren't here to talk about shopping trends or foot traffic. We are here to look at the math. We're going to sift through their financial data, run the absolute and relative models, analyze their actual assets, and ultimately try to calculate the true intrinsic value of their shares. Let's get to work.
All right, let's just jump right in with the current share price, $21.50. That is where Macerich's stock recently closed. Now, as you probably know, a stock price all by itself tells us absolutely nothing about whether a company is actually cheap or expensive. It's really just the entry ticket. But for us, as analysts, this number represents the central mystery of our case study today. Does this $21.50 represent a bargain, a fair market value, or a massive overvaluation? To answer that, we've got to look under the hood.
And right away, we hit this glaring paradox at the heart of Macerich right now. On one hand, the stock has been on an absolute tear. The year-to-date return is a very healthy 17.5%, and the trailing 12-month total return, which includes their dividends, is a staggering 46.1%. The market clearly loves this stock right now. But then you look at the underlying fundamentals and they are bleeding. Their trailing 12-month net income is negative $197.9 million. And their free cash flow, the actual cash left over after running the business, is negative $11.7 million. So how on earth does a company hemorrhaging cash generate a 46% return? We really need to find out.
To figure this out, we're going to follow a highly structured four-step analyst roadmap. 1. Absolute models to find the cash. 2. Relative models to gauge the peer pressure. 3. Asset valuation to determine the book value. And 4. Synthesizing the intrinsic value to get our final answer. Okay, step 1. Absolute models, finding the cash.
Now, the absolute gold standard for this is the discounted cash flow, or DCF model. The logic here is just beautiful in its simplicity. A company is only worth the sum of all the free cash it will ever produce in the future, discounted back to today's dollars. If we can project Macerich's future free cash flows, we can discount them using their weighted average cost of capital to find exactly what the stock is worth today. But, well, we have a major problem.
Running a standard DCF on Macerich right now is virtually impossible. Remember, their trailing 12-month free cash flow is negative $11.7 million. Trying to calculate an intrinsic value by projecting negative cash flows into perpetuity is literally like trying to squeeze lemonade out of a dry brick. You just cannot do it without making wild, heroic assumptions about a future turnaround that currently has zero basis in their trailing data. So as analysts, we have to pivot. To make our absolute valuation work, we need to bridge these data gaps by explicitly stating our assumptions. We are going to assume a sensible, conservative terminal growth rate of 2%, which aligns nicely with long-term inflation. We'll use an estimated cost of equity of 8%, which reflects the higher risk profile of a leveraged retail REIT like this. And later, for our relative models, we'll benchmark them against sensible retail REIT peers. Since the standard DCF is totally broken here, and a residual income model requires reliable baseline equity data that is frankly currently stressed, we're going to rely on a dividend discount model, or DDM. Why? Because Macerich actually pays a dividend, which finally gives us a tangible cash flow to measure.
So here is how this builds our first really solid intrinsic value estimate. First, we identify the current dividend yield, which the data tells us is 3.16%. Second, we look at dividend growth. Their 5-year compound annual growth rate for dividends is 2.61%, so our assumption of a 2% long-term growth rate is perfectly grounded. Third, we apply our 8% cost of equity hurdle rate. When we plug all these inputs into the DDM formula, taking the expected dividend and dividing it by our cost of equity minus our growth rate, we get our first major clue.
The math spits out a calculated fair value price of exactly $15.48 per share, based purely on their discounted cash flows and dividend capabilities. Remember, the current stock price is $21.50, so immediately our absolute valuation model is flashing a huge warning sign that the stock is trading well above its intrinsic cash-generating value.
Moving right along to step 2, relative models, the peer pressure.
The story these multiples are telling us is, honestly, pretty alarming. First off, the trailing price-to-earnings ratio is negative 27.92, simply because they're losing money. But get a load of that forward PE, 454.55. Investors are paying a staggering 454 times expected future earnings. And the enterprise value to EBITDA ratio is 19.38. For a little context here, a healthy, mature retail REIT usually trades closer to an EV to EBITDA of 10 to 14. A near 20 multiple suggests the market is pricing Macerich at a massive premium, expecting this explosive growth that just isn't visible in their historical 0% earnings and free cash flow growth rates. If we applied a standard pure multiple of 12, the implied intrinsic value per share would completely plummet into the single digits, well below today's price.
Okay, step 3, asset valuation, the book value.
A really quick proxy for asset valuation is the price-to-book ratio. Macerich's PB ratio is currently 2.26. Backing this out, it implies a true net asset value, or NAV, of roughly $9.50 per share. So why on earth are we paying more than double that at $21.50? Because of their debt. Their debt-to-equity ratio is 2.07. They have more than twice as much debt as they do equity. This balance sheet is incredibly encumbered, meaning the true net asset value available to shareholders in a liquidation scenario would be fiercely contested by creditors.
Now, to be perfectly fair, the real estate itself does generate massive top-line numbers, pulling in over $1 billion in trailing 12-month revenue. The properties are definitely active. But we have to talk about the liquidity risk. Both their current ratio and quick ratio sit at 0.83. In accounting terms, anything below 1.0 means a company simply does not have enough short-term assets to cover its short-term liabilities. Trying to adjust this balance sheet to fair market value is really challenging because that liquidity crunch creates immense operational risk.
Which brings us to step 4, synthesizing the intrinsic value.
Let's bring it all together. The market is asking you to pay $21.50 for a slice of this business. However, our relative peer models imply a single-digit value, our asset NAV points to roughly $9.50, and our absolute DDM valuation, which is honestly the most optimistic metric we have today, pins fair value at $15.48. Using our most generous model, we have a margin of safety of negative 38.91%. As an equity analyst, you want a positive margin of safety. You want to buy a $20 bill for $15. Right now, the market is asking you to buy a $15 bill for $21.50. By every fundamental metric across our valuation range, the stock appears severely overvalued.
So the absolutely crucial point here is understanding why the intrinsic value is so low compared to the stock price. And it all comes down to some glaring red flags. Just look at that payout ratio, 101.81%. Their 3-year average free cash flow payout ratio is even worse at 114.24%. This means Macerich is consistently paying out more cash in dividends than it actually generates from its operations. They are yielding a negative 3.54% on earnings, and the return on invested capital is a measly 2.22%, which is just far below any reasonable cost of capital. The valuation is incredibly fragile because the dividend that is essentially propping up the stock price is structurally unsupported by current cash flows.
Which brings us to the ultimate question you really have to ask yourself here. The market has pushed this stock up 46% over the last year, seemingly completely ignoring the fundamental cash drain. Clearly, investors out there are pricing in a miraculous operational turnaround, or perhaps a lucrative buyout. But based strictly on the math, the fundamentals simply do not support the price. So, with a payout ratio over 100% and negative free cash flow, is Macerich's 3.16% dividend a dangered yield trap, or are you looking at a brilliant turnaround waiting to happen? I will let you weigh the evidence and decide for yourself. Thanks so much for joining me on this deep dive into Macerich, and keep making those informed, structured decisions.